no reason why we wouldn't achieve that $3,000 an ounce target. And that seems like a significant increase from where we are today. It's over 50% or
Right. So one of the things that we touched on last time was that these transactions that you've done this year are happening in what you believe is a pretty promising gold market. I
Mhm.
believe you're talking about how you believe we could see a $3,000 gold price, not in the long term, but in the shorter term, kind of within a month's time frame, not years. So I also wanted to review and go a little deeper on that and just hear your argument for why you think that's possible, especially as we sit today still below 2000.
Well, we just have to look at the headline inflation numbers, and what they're indicating is the excesses that have been introduced into the system really since the last credit crisis back in 2009, when we saw a coordinated effort by the central banks globally to quantitatively ease, in other words, print more money. And that's been unrelenting really since the credit crisis. And now we're seeing the evidence of that in headline inflation numbers. But what I would argue is the headline inflation numbers severely underestimate and understate what real inflation is. It's certainly not 5, 6% as the headline numbers would indicate. I think we're all experiencing double-digit inflation in our everyday lives when you consider the cost of food, fuel, the cost of real estate, which has gone up 30, 40% in major urban centers. So the cost of living has gone up almost exponentially. And that's because of all of the excess paper that's been introduced into the system. Gold is the one currency you can't print. It's very finite in quantity. It's inevitable that gold will go up. I would argue that it hasn't gone up appreciably because cryptocurrencies have displaced us somewhat, particularly with the new generation of investors that come into the space. But cryptocurrencies don't have the physical properties and indestructibility that gold has. And I think at the end of the day, we're going to see rotation out of cryptocurrencies into gold as the excesses in that system start to deflate.
Right. So this week we did have the Fed have its latest meeting. They seem to be taking some action on inflation right now. We've heard they may speed up the tapering process. We've heard maybe 3 interest rates hikes next year. So how does that fit in with what you see coming?
Well, what's clear to me is that inflation will continue to go up even as interest rates get tight, and it'll take quite a bit of time for that those excesses to be removed from the system. And so we're actually going to see, I think, real interest rates continue to decline deeply into negative territory. And that's simple arithmetic. That's the nominal rate less inflation. And well, we're already deeply into negative territory right now. Short-term interest rates are -4, -5% when you consider headline inflation numbers. And I think actually quite a bit more negative than that when you consider what real inflation is. And I think real inflation will continue to go up even as nominal rates go up incrementally. And so negative rates will go deeper into negative territory. Interest rates will go deeper into negative territory. That will inevitably drive the gold price up. And there's been an example of this in history. If you go back when Paul Volcker became the head of the Federal Reserve in the late 1970s, when we were experiencing real double-digit inflation, the last hyperinflationary cycle, even as he was raising interest rates, it took a couple of years for real rates to start to go up from negative territory. And gold actually did extremely well at the beginning of that interest tightening cycle. So it really didn't achieve its peak until 1981, a full 2 years after Paul Volcker started introducing higher interest rates. And he was far more aggressive on interest rate hikes than we believe central banks will be in this cycle. They're going to be quite a bit more tentative because they pay much more attention to the level of the stock market than they do real inflation rates.
Okay, so we've got a lot of things going on right now. We have inflation numbers that we can tell are higher than we're being told that they are. We have the Fed with this plan and timeline that it doesn't really look like it's going to be able to follow. So what would your advice for investors be? Where can they look to find true sources of information on what's going on here?
Well, look, I think that what you need to do is anecdotally look at what real prices are doing in everyday goods and supplies. And we're certainly seeing in the mining industry where we're seeing double-digit inflation in capital and operating costs. And we've seen every major producer in the gold industry come out with updated cost guidance on major capital projects, on day-to-day operating costs that indicate that real inflation is quite a bit higher what the headline numbers are. So there are a number of data points you can look at within various industries to see where inflation really is, with not only with the bottlenecks that we have in the system that may be temporal, but because of the excess that has been introduced into the system over the last decade in terms of increased money supply. And so I think gold as an asset class is going to afford investors a measure of protection against the erosion they're going to see in their capital bases as inflation eats into savings. Gold will protect you against that. And then the question that you have to ask yourself at that point as an investor is, how do you best play gold to safeguard your capital and protect your assets? And my argument is you should be in the royalty space. That's why I position myself after 32 years of operating and building mines at this end of the spectrum, because it provides you that top line exposure to the upside in the gold price while insulating you entirely from operating capital cost inflation. And that's a concern I have about mine operators right now. As well, they'll enjoy the upside in the gold price, they may not get the expanded margins you would expect in an increasing gold price environment because of inflation and their cost basis.
Right. And so as we look forward to 2022, do you have a specific price trajectory that you would expect to see gold go on over the next 12 months?
Yeah, again, I see no reason why we wouldn't achieve that $3,000 an ounce target. And that seems like a significant increase from where we are today. It's over 50% or thereabouts. And I would say, you know what, when it happens, it's going to happen quickly and violently, as it normally does in commodity cycles. It's not a steady upward trajectory to those types of targets. It tends to happen violently. It certainly happened that way in the copper space recently when we saw all-time highs for copper. It wasn't that long ago, literally months, not years, when copper was approaching $2 a pound. And now we've seen it approach close to $5 per pound. When the market starts to react, it reacts quickly and violently to the underlying fundamentals that drive that type of price action. It's not a steady upward trajectory. I believe we're going to see the same type of dynamic in the gold space. I think the catalyst will be a correction in the general equity markets, which are overextended. Multiples really have been distorted beyond recognition. And I would say in the cryptocurrency market, a correction is inevitable there. The valuations there make no sense. Investors are buying it with the expectation it's a reserve currency. It's going to protect them against volatility in the general equity markets. But that is not a safeguard of assets when you have volatility of 40 to 50% in a day. That's not a protector of capital. That's a destroyer of capital. And I think inevitably, given the lack of physical properties, lack of any intrinsic value in cryptocurrencies, I think you're going to see a migration of capital out of cryptocurrencies into gold, which has been a currency physically backed for 4 millennia.